In this class, we will discuss about kinds of accounting principles. The accounting principles can be divided into two parts, concepts and conventions. Concepts used to connote the postulates, that is, necessary assumptions, conditions, and ideas which are fundamental to accounting practice. With emerging social changes and research in accounting, many changes are likely to emerge in the future in the field of accounting theory. There are 10 accounting concepts we will discuss today. These accounting concepts are as follows. Number 1, entity concept. Number 2, dual and aspect concept. Number 3, going concern concept. Number 4, accounting period concept. Number 5, money measurement concept. Number 6, cost concept. Number 7, matching concept. Number 8, realization concept. Number 9, accrual concept. And number 10, verifiable objectivity concept. First, we will discuss entity concept. Entity concept means business and proprietor are separate. According to this concept, business is treated as a separate unit and distinct from its owners, creditors, managers, and others. I can explain it by an example that if proprietor is investing capital in the business, we make entry, journal entry, cash account debited to capital account. Cash that comes in invested by the proprietor and capital represents the owner. His name is not written. Due to the separate entity concept, the proprietor's house, his personal investment in securities, his personal car, personal income, personal expenditure are kept separate from the accounts of the business entity. Business unit should have a completely separate set of books, and we have to record business transactions from firm's point of view and not from the point of view of the proprietor. The proprietor is treated as creditor of the business to the extent of capital invested by him in the business. The capital is treated as liability of the firm because it is assumed that the firm has borrowed funds from its own proprietors instead of borrowing it from outside parties. In brief, we can say only business transactions are recorded and not the personal transactions of the owner. Personal assets of the owners or shareholders are not considered while recording the assets of the firm. Income is the property of the firm unless distributed to owner. The second concept is dual aspect concept. This concept is based on double entry system of bookkeeping. This is the core concept of accountancy. Every business transaction affects at least two aspects of the business. Every transaction has two sides, at least. If one account is debited, then another account is credited. Every financial transaction involves duality of effects, yielding of a benefit and the giving of the benefit. Assets is equal to liabilities plus capital. For example, we can say Mr. X has started business with rupees 4 lakh in cash and took a loan of rupees 1 lakh from the bank, and these 5 lakhs have been utilized to buy some assets. So assets are equation is formed assets is equal to liabilities plus capital. Assets is rupees 5 lakh, liabilities are 1 lakh and capital is 4 lakh. Then the third concept is going concern concept. According to this concept, any enterprise which is expected to continue operating indefinitely in the future. This concept assumes that the business will continue to exist for a long period in the future. The transactions are recorded in the books of the business on the assumption that it is a continuing enterprise. Fourth concept is accounting period concept. As per going concern concept, business is intended to continue indefinitely for a long period. The true results of the business operations can be ascertained only when the business is completely liquidated. but ascertainment of profit after a very long period will be of little use to proprietors. Hence, they ascertain after a fixed time period, that is annual time period, that is a period of 12 months. There are two periods. One is calendar year that starts from 1st January and ends in 31st December, and another is financial year that starts from 1st April and that ends 31st in the next calendar year. This is the accounting period concept also. Fifth is money measurement concept. Measurement unit is necessary for accounting. Only those transactions and events are recorded in accounting which are capable of being expressed in terms of money. Money is the common measure. The various assets or transactions having different units cannot be properly recorded. So it is necessary to quantify in terms of money. For example, the various assets of business, say 4 machines, 1 building, rupees 1 lakh cash, 5 tons of raw material cannot be aggregated. So they are converted into money value, such as machinery is of 40 lakhs, building is of 1 crore, cash 50,000 and raw material worth rupees 60,000. There are limitations of this concept that qualitative factors such as general health condition of the chairman of the company, working conditions, trade union, and management relationship, honesty, loyalty of employees cannot be measured in terms of money, so they are not recorded in the books. As per this concept, transactions are at their money values on the date of occurrence, and it does not record further changes in the value of money. Money does not provide any stable measurement or yardstick for this purpose, so it requires the measurement of the effect of inflation or change in the price level to report the correct amounts of profits and financial position. The sixth concept is cost concept. According to this concept, the value of an asset is to be determined on the basis of acquisition cost. The original or acquisition cost relates to past and therefore it is referred to as historical cost. It is the basis for the valuation of the assets in the financial statements. Further, cost concepts means original or acquisition cost less depreciation charged on that asset. For example, a machinery was purchased in 2002 at a cost of rupees 1 lakh. In the year 2002 and afterwards, these assets will be shown in the balance sheet at a cost of rupees 1 lakh less depreciation. Another concept is matching concept. This concept is very important for correct determination of net profit. According to this concept, in determining the net profit from business operations, all costs which are applicable to revenue of the period should be charged against that revenue. Accordingly, for matching cost with revenue, first revenue should be recognized and then cost incurred for generating that revenue should be recognized. Following points must be considered. Number 1. When item of revenue is included in the profit and loss account, all expenses incurred on it, whether paid or not, should be shown as expenses in the profit and loss account. On the basis of this concept, outstanding expenses, though not paid in cash, are shown in the profit and loss account. Number 2. When some expenses, say insurance, is paid partly for the next year also, the part relating to next year will be shown as an expense only next year and not this year. This means that part of the insurance against which benefit will be derived or revenue will be earned in future should be shown in the balance sheet as an asset and the rest is treated as an expense during the current year. Number 3. Cost of the goods remaining unsold at the end of the year together with the expenses incurred on it must be carried forward to the next year, as these goods will be sold only during the next period. As such, the closing stock is carried over to the next period as opening stock. Lastly, incomes receivable must be added in revenues and incomes received in advance must be deducted from revenues. The eighth concept is realization concept. According to this concept, A concept which gives accounting recognition to an exchange transactions such as sale of goods or services only when an inflow or outflow of cash equivalent results. The realization principle holds that revenue should be recognized with accompanying gains or losses at the point of sale in an arm's length transaction. If the earning process is virtually complete, this is a widely used practice. According to this concept, revenue should be recognized in the period in which sale is deemed to have accrued. Number 2, revenue from services rendered is recognized when services have been performed to the satisfaction of the customer and are billable. Revenue from disposal of assets other than products is recognized at the date of sale. Revenue from permitting others to use enterprise assets such as interest, rent, and royalties is recognized as time passes or as the assets are used. For tangible products, revenue is recognized not when a sale order is received, but when a contract is signed, not when goods are manufactured, but rather when the product is shipped or delivered to a customer. The ninth concept is accrual concept. The accrual concept is concerned with the period in which the revenues and expenses are to be related. In other words, once the revenue is realized, the next step is to allocate it among the accounting periods if necessary, and this is achieved with the help of accrual concept, which also relates expenses to revenue for a given accounting period. It is true to say that matching concept finds its true expression in accrual basis. The matching concept implies that the revenue for the current year only should be matched with the expenses for current year. The expenses for the current year include the following. Number 1, such revenue expenses as relate to the current year and the payment of which has been made in the current year. Number 2, such revenue expenses are related to the current year and the payment of which had been made in the previous year. Number 3, such revenue expenses as relate to the current year and the payment of which has not been made in the current year but will be made in future. Similarly, the revenues for the current year will include the following. Number 1, revenues related to the current year and received in the current year. Revenues related to the current year and were received in the previous year. Number 3, revenues related to the current year and are not received in the current year but will be received in the future. So this was the ninth concept, that is accrual concept. The last concept is verifiable objectivity concept. This is the 10th concept, verifiable objectivity concept. This concept means that all accounting transactions that are recorded in the books of accounts should be evidenced and supported by business documents. These supporting documents are cash memos, invoices, vouchers, bank deposit slips, bills receivables, correspondence agreements, etc. The journal is the first book in which we record when we do any transaction, and we do journal entry on the basis of certain evidence. These evidences are bills, cash memos, invoices. For example, if we have purchased any goods, then we record purchases account debited to cash, and this is recorded on the basis of the bill which we have got from the supplier. On the basis of that, we write the amount, we write the quantity, etc. in the journal book. These documents supply the necessary information on the basis of which entries are made in the books of accounts. Also, these documents provide a base for audit. This principle also requires that accounting data should be free from the personal bias of either management or the accountant who prepares the accounts. Accountants should follow the uniform method for stock valuation, estimating the likely amount of bad debts, allocation of certain costs over various periods, etc. So these were the 10 accounting concepts. Thank you.